Good morning and welcome to the Killik podcast for Friday the 10th of April. This week the market's been characterised by the very poor jobs number we saw in the United States when we were off on Good Friday. That's actually been quite good for developed markets, but it's also been very good for emerging markets. We'll go on to talk about that in a bit. Again, we go back to this economic surprise index, which I think characterises how disappointing the US economy has been since the beginning of the year. And we're now back at levels where we really do think that the economic numbers have to start to improve. But this poor data that's been coming out of the States has made the market reassess when interest rates are going to go up. And the Fed is at the moment in a holding pattern, waiting for better data before they can raise rates. And that's had a real impact on emerging market economies, because the market thesis at the moment is that the dollar will strengthen with interest rates coming out of the States, and therefore emerging market currencies will weaken. And that'll force capital outflows out of emerging markets. And in order to stem that, emerging market central banks will have to raise interest rates. And that's at a time when they shouldn't be raising interest rates, because commodities have been weak, and therefore we've seen poor economic GDP numbers from these countries. But that's not playing out because interest rates are staying on hold in the States at the moment. And as you can see, the emerging markets really have outperformed more recently as the market have got more confident about rates staying lower for longer in the States. So how are we playing the emerging markets? We're playing it through Aberdeen Asset Management. We issued this buy note relatively recently. This is because the group has around 64% of their assets in emerging markets or Asia Pacific, but they recently bought Scottish Widows, which is reducing that concentration. So the risk of the overall equity begins to fall. We really like this because of the hugely cash generative nature of the business. So we feel that the business can generate around 50% of its market cap over the next 5 years in terms of free cash flow. And that'll take the cash balance, which is currently at around 473 million, assuming they raise their dividend at 10% per year, to over 2 billion by 2019. So they can use that cash flow to enhance the growth rates coming out of the business. The valuation is also extremely attractive. It's on 12.5 times 2016 earnings with a yield of 4.4. And that stacks well against the likes of Henderson on 16.8, yielding 3.8, and Schroders on 17.9, yielding 2.6. So what's going to happen next week? So the US results season for Q1 really kicks off in earnest. And going into these Q1s, we've seen a lot of downgrades. So we've seen around 5% downgrades to the S&P 500 in terms of earnings. And in this chart, you can see all the red lines are companies in absolute numbers downgrading their numbers going into their results. So you can see a huge amount of red relative to the amount of green. We're also seeing downgrades for Q2 in the States. So we've got 2 consecutive quarters of negative numbers, which is an earnings recession. And that's pretty rare when you've got overall GDP growth still rising. So we've seen that in 86, 98 and 2012, we saw this sort of scenario. Typically, you see markets continue to go up despite the earnings downgrades, because people are looking through this period of weakness in earnings and expecting it to start to rise in the second half of the year. And that's certainly where we are at the moment. And the downgrades have principally been through FX and the weaker oil price. So we had Alcoa earlier this week. So they tend to be a canary in the coal mine for results, because they're always first to report. They disappointed in terms of numbers, but their guidance was better than expected. So we think that's a fair outlook for what we'll see in Q1. So looking at some of that, firstly, in terms of the Killik stocks, we've got Johnson & Johnson coming in on Tuesday with Wells Fargo, also JP Morgan reporting. On Wednesday, we've got some more US corporate financials. We've also got Netflix, will be interesting because that's a thematic investment we follow quite closely. On Thursday, we've got Unilever, which again will be interesting. Goldman Sachs, American Express, Schlumberger, all very big names. And on Friday, we've got some general GE, which is obviously a big barometer for what's going on in the industrial space globally. Just looking at J&J, this business has been a good solid performer. Again, it's another cash generative business, and that's why we like it. So their current cash pile is around 25 billion, growing to 35 billion by 2016, then 42 by 17. Their core business has been tracking well, so we hope to see that coming through in the numbers, and we expect small acquisitions to start to enhance that 7% organic growth rate. So that's it from me. Have a good weekend. Thanks very much.